Um,
Sorry, new audio prompt.
yeah, no worries, Dave. That's fine. We're the leading accelerator in the MENA region. We were established in 2011 in Egypt, Cairo. We have since gone on to establish 7 locations, which I can also discuss. We've established 8 seed funds as well. All of these LP-GP relationships are different in each of the locations that we have. We've invested in over 300 portfolio companies, and we've conducted 18 startup programs, invested in over 300 portfolio companies, and we have about $85 million of assets under management. So what do? We do a couple of different things. So first of all, we offer seed funding. The seed funding is generally between 50 to 500K. It is typically seed, but we've now started to explore the idea of doing a pre-series A ticket. The program in Abu Dhabi is quite a large seed. It's 150K for between 5 and 10% equity of your company. But the other thing that you get with our program is the promise of a follow-on fund. So if your company scales well within the program and afterwards, we have the ability to deploy between 400 and 600,000 US dollars additional to our initial funding. Startup programs, as I've mentioned, so we run startup programs comprised of coaching, mentoring, and training. And then we also integrate with corporates. One of our main premises is to try and engage corporates as much as possible within each of our geographies. So the idea is to try and find champions within each corporate that we work with and try and work on proof of concepts, as well as trying to get you actual projects within each of these corporates. So where have we been? So as I mentioned, we started in Egypt, Cairo in 2011, then we scaled really across the GCC. So we have presence in Saudi Arabia, the UAE, Tunis, Lebanon, Bahrain, and Jordan. And the idea is that we try and really leverage the relationships that we have with each of the offices. So there's a lot of co-sharing in terms of if you're a company perhaps based out of Bahrain, but wanting to scale into Saudi Arabia, we're able to leverage a relationship that we have with the office in terms of helping you establish presence in Saudi and getting you the right coaches, mentors, and trainers in each of those geographies in order for you to better understand the market and be able to really scale your product in that market. So our recent reestablishment with Flat6 Labs in Abu Dhabi is in partnership with a company called ADQ. ADQ is the second largest sovereign wealth fund of Abu Dhabi. They have over $115 billion of assets under management. On this seed program, we've been given $35 million to invest in startups over the next 3 years. We plan to invest in over 60 startups. To begin with, the program is somewhat sector agnostic, but later on, we'll be looking to try and become more tailored to the industries that they already have ownership within. May that be tourism, health tech, ed tech, and so forth. So we're going to try and backward integrate, look at some of the portfolio companies that they have, and try and find the right fit for the startups to actually integrate into the existing portfolio. The accelerators that we'll be running. So for this particular cycle, the bootcamp now is comprised of about 20 teams. Of the 20 teams, between 8 to 10 startups will be picked, which means that you have about a 50% chance of being picked at the end of the program, at the end of this bootcamp. In terms of ADQ, as I mentioned, a massive portfolio of companies, over 80 companies in their portfolio, of which we've identified about 20 that we feel would fit the mandate that we're currently running. Some of the companies that they own lie in the fields of manufacturing, health and medical services, insurance, real estate, utilities, ports and logistics. And some of the names that you might have heard of are Etihad Rail, 2454, Anantara Hotels, Image Nation. Again, the whole premise of this accelerator is to try and fund you, educate you on the core principles of lean startup, but at the same time to try and incorporate as much backward integration into some of these corporates. So it's trying to really open doors and for you to try and test your product with some of the names that I mentioned on the left-hand side. The selection process. So we've been through a rigorous selection process. We've had, between 500 to 600 applicants for this particular cycle. And how do we usually go about that? We usually go about that in a number of different ways. We have a larger budget in terms of outreach, in terms of trying to find global startups from all over the world. Our program is designed for international startups, not just for regional specific startups. We also spend a lot of time in terms of outreach. So we attend all the large tech events, and at those tech events, we actually physically go scouting for startups that we're interested to try and bring into our accelerator. After this filtration process, we go through a number of questions and due diligence process to take the 500 to 600 applicants down to 50 applicants. Those 50 applicants are interviewed, and a number of you have gone through the interview process to try and better understand more about the team and more about the product. After we completed the interviews, we then invite you to the boot camp, which you're attending today. And we take you through the boot camp over the next 4 days, leading up to pitch practices. The pitch practices then opens a door into something called the selection committee. The selection committee comprises of myself and 4 other judges. One of the judges is our CEO for Flat6 Global. And then the other candidates you'll find out about on the day. I'll leave it as a surprise, but they're comprised of people who actually work for large VCs regionally. And very, very interesting people with very interesting CVs. During the selection committee, you will be asked to pitch. Your pitch should be no longer than 4 minutes. In the 4 minutes, and again, Dave will explain later on the flow of the slides and exactly what is expected in the pitch. After the 4 minutes, it goes into Q&A, and it's very much like Dragon's Den or Shark Tank, where you would be questioned about the product and asked to answer a number of questions. Then what happens is that we rank you from 1 to 10. Of course, the other 10 will not be selected. So 10 of you will be eliminated, but from 1 to 10, you will be given offers based on your ranking. So if you rank higher up, it's more likely that your offer will be the 150K for 5%, and the lower down that you rank, the offer looks more like 150K for 10%. Then what happens is that we have a month of negotiation. So we'll be sharing you the SHA term sheets, which you'll then review. There'll be a little bit of back and forth in terms of questions. And then after that process happens, we'll then begin the cycle towards the end of June, leading all the way up till September. And September leads up to something called a demo day. A demo day is typically a large scale event which would have happened physically. There's still a chance that this might happen. If this is the case, we will actually bring you into Abu Dhabi to present to a large audience of high net worth individuals, angels, and VCs. If not, what we do is we film it in a recording studio and actually publish it online. If you go to Flat6 Labs demo day on YouTube, you can actually watch a number of YouTube videos of exactly how our demo days look like, and what the finished article looks like in terms of the startups that we have. So yeah, some of the things that you will learn on your journey is product, market growth, and fundraising. And again, we've tailor-made, the way that the flow of the program. And the idea is to have this coaching, mentoring, and training from a number of world-class coaches, mentors, and trainers that we actually have in-house and we have access to. We also help in terms of legal setup. So some of you already, well, most of you have legal incorporations, so we just need to be added onto your legal setup as a shareholder. However, the ones that are not legally set up, we're able to support with that. Of course, we also have office space. And again, if any of you are based regionally or have the intention to try and fly in and establish a base in Abu Dhabi to service the GCC, we actually can provide the office space for you for up to 6 months. We also have a number of other perks. So we're part of something called the GAN network. The GAN network opens up a number of discounts and access to a number of different platforms. So for example, as soon as you get selected into the program, you're given $10,000 worth of Amazon Web Service credits, as well as a number of other benefits to avail. Again, as I mentioned, we're going to have the demo day, but I think one of the main things that we really pride ourselves here at Flat6 Labs is helping you scale your business and helping you grow your investor base. Once we become vested in you, we want to try and make a good return on our investment, and we have a fantastic network of relationships with angels and VCs, specifically regionally, as well as some large stakeholders outside of the region as well. So some of the companies that we've invested in that have gone on to do very, very well are the likes of Harmonica, which was a company which was based out of Egypt, was very similar to Tinder, but it was the Arab version of it. So it was a matchmaking app where actually parents got involved in the matchmaking. We eventually sold this company to Match.com, made a 16x return on our investment. So we're very, very happy with this. Some of the others are the likes of Brimmore, Instabug, Sync, Money Fellows. And again, you can go on to research some of these companies that have gone on to do very, very well. One which is kind of very relevant to the Abu Dhabi accelerator was Washman. Washman is a online laundry app, and at the moment they've gone on to raise over $10 million, and they've probably at a valuation of about between $50 to $60 million. So again, one of the things that we really think that the accelerator gives is it really validates your startup. It gives you an extreme amount of validation. Our investor network understand that we've done the first round of due diligence in terms of looking at the companies, going through 500 to 600 applications and really bringing it down to the 10 applicants that we actually invest in. There's that level of confidence that if we've done our homework, they'd be more comfortable to make a follow-on investment. So that's pretty much it from me. I'd like to open up the floor to any questions that you may have before I hand over to Dave, who is going to take you through the program over the next 4 days. Any questions?
Ryan, that was actually pretty good and pretty clear. So definitely looking forward to the day and how things progress.
Brilliant. Thanks a lot. Anybody else?
I have a legal question.
Sure.
So if we are not incorporated yet, we will be incorporated in the free zone, media zone of Abu Dhabi. Is it correct?
Correct. It's most likely going to be ADGM that we would establish your company. But the idea would be that actually you would establish the company, but we'd give you some legal support. So we give you access to legal hours. to actually understand the process and help you through the journey of establishing. With the other founders, for example, if you're established in Delaware, we're more than happy to just be added to the Delaware license. And then once we're added to your legal registration, the capital is deployed based on that. Any more questions?
Hi, Orion.
Hi.
Finally, good to see you, because I think the last time we chatted was quite an intense conversation, given our nature of business. But yeah, looking forward, and it's wonderful to see so many people on a single plane. Finally, good to see faces rather than voices.
Yeah.
Morning to all, and looking forward.
Great. Excellent. So Dave.
Hello, Ryan.
Oh, sorry. One more.
Yeah.
Go ahead.
Hello, Ryan. This is John from Flat6. I just had a question about the follow-on investment. Does it only come in the form of pure equity investment, or it comes of mixed safe, convertible bonds, or even loan?
Yeah. So yeah, we're with the follow-on. We're quite open to doing safes, convertibles, KISS. So yeah, we're open to different forms when it comes to follow-on.
Got it. Thanks, Ryan.
Yeah.
May I ask one question, Rian?
Sure.
Yeah.
Go ahead.
About the all the process, I mean, including the negotiation. So when, I mean, is expected the investment to be finalized? Usually, I mean, based on the previous cycles.
Sure. Well, usually the investment comes as quick as we're on the commercial registration or on the actual document of the company. So we deposit the money. I mean, the funds are all there, right? So we've been given $35 million from ADQ. It gets deposited in tranches. But obviously, as soon as the cycle starts, the money lands into our bank account, and as quickly as you can get us onto your commercial registration, we can deposit the cash.
In our case, we are already registered in Italy. So
sure, but the change on the commercial registration to actually put us as a legal shareholder on your commercial registration is how quickly we deposit the cash. So it usually happens within the first 2 weeks, let's say, of you joining the program.
Thank you. Yeah. And good morning to all of you.
Great. Any more questions, guys? Right.
I have one more question.
Sure.
When will we hear about the results? The selection committee is on Thursday, but when the feedback will come?
So yeah, what happens is Thursday's selection committee happens. Then I have a board meeting on the Sunday. And then on the Sunday, we actually decide if what was discussed in the selection committee, the top 10 ranking, is approved. It gets approved on the Sunday, and I'll literally send you if you've been selected or not by Monday next week. So that's how it works.
Yes, hello everyone. I also have a question about the follow-up funding. So as far as I understood you, so the first investments, they are going to be sent or in exchange for 5 or 10% of the company's equity. So, and correct. I'm just curious to know about the follow-up investments of or 400K or like 600K. How much of equity would we need to share with you or in exchange for it?
Yeah, it's a good question, actually. I don't think there's a clearly defined amount on that. It really depends on how quickly you're able to scale your business. The follow-on doesn't come, obviously it will take a period of time for you to scale your product and you to get the traction for us to give that follow-on investment. So I don't think there's a clearly defined timeline, and I don't think there's a clearly defined amount of equity that we'd be looking to capture. All I'm saying is that we do have the ability to provide 400 to 600K for any of our investments. Obviously, it's not going to happen for all of you. The reality is that a lot of startups fail during the process. Yeah, we do have the ability to continue to support you. And it's not just that initial seed ticket that we'd be giving you, especially if you're doing very, very well.
All right, thank you.
Right.
I have a question, please.
Sure.
Hi, everyone. I'm Noha from Ziwa. I have a question about the 4-month boot camp. So, like, is it going to be mentoring sessions, and is it going to be virtual? Like, how is the format going to be like?
Sure. So it's not a 4-month boot camp. The boot camp is only this week. The program is over 4 months. The program is coaching, mentoring, and training. Typically, it's like 1 to 2 hours a day that we would expect from you. The rest of the time, should be working on your product, business development, scaling your product. To begin with, it will be done virtually. We're currently in the process of establishing a 400 square meter office in Abu Dhabi, which you'll all have access to and can stay there for up to 6 months and actually register the company to be based out of the office. I think perhaps halfway through the program, 2 months into it, especially as travel restrictions ease up in Abu Dhabi, because as you're probably aware, some of you that are already based here, there's a 10-day quarantining process as you land into the country. That will be lifted hopefully by the 1st of July, which means that, we're more than happy to host you here and for you to actually, have your startups here. And to be honest, that's kind of the more ideal for us. I mean, we want to be working with you physically. We want to be able to see you. We want you to be talking to one another. I think one of the biggest learning experience that we've had when I've been the MD in other accelerators, I was once based in Bahrain, was that there was a lot of interaction between the startups, and a lot of the learning actually came from some of our alumni companies that would come in, sit with the cohort and actually go through the journey that they've been through and explain the struggles and lessons learned. So yeah, the idea is maybe 2 months into the program, or maybe even a month if we're lucky, we could actually start bringing you into Abu Dhabi and have you based here. I know that it might not be possible for certain companies that are here to relocate, but the ones that are specifically already based out of the UAE, we'd love to see you and have you physically in the office.
Perfect. Thank you.
Great. I think that's all the questions.
Can I ask a question?
Sure.
Hello, it's Andrei from Aninet. I have a question about the company creation. Do we need to travel to Abu Dhabi to establish the company, or is it possible to make through the process remotely?
I need to double check that for you. I don't have the answer to that right now. I assume that it would be able to be done virtually without you actually physically being here. But we'd need to double check that.
Great, thanks.
Yeah, great. All right, if that's all the questions, I think I'll hand over to Dave and allow him to introduce himself and then tell you a little bit more about what we're going to be doing over the next 4 days. Great. Thanks
Awesome.
a lot, guys.
Thanks, Ryan.
Take care.
Hey, everybody. Welcome. Let me see. I'm going to share my screen here with you. Hit the, I'll walk you through the agenda. You've probably already seen, but just to get everybody on the same page. And then make some introductions about me. So over the next few days, we'll be really spending some time if you think about this as getting your slide deck ready, it's really what goes onto the slide and what's behind the slides that we're really going to break down. So for example, this morning we're going to talk about what's the slides, what's the format, where's your areas of strengths and weaknesses for your team, so you can do a self-assessment this morning. Which kind of highlights where there's opportunities for you in the next few days to really get answers to questions around some areas of weakness. We're going to spend a lot of time today talking about your market sizing, competitive analysis, and in the day we'll wrap up with some awkward co-founder discussions and making sure, but for some of you have already incorporated, some of you have established businesses. So we have a range of company profiles here today. So I'm going to try to, I'll cover a range for that. So, you know, but recognize that some companies here are still pre-revenue. Some companies have significant revenue. So we've quite the wide range. So we'll be today talking about, this is the agenda. I will share this link for you as well. Hold on. So as well as the slides. So and every day I'll post the slides and the recordings from the previous day on dkparker.com. So that link will take you to the slides, and on SlideShare you can download them and follow along if you like. And I'll make sure that at the beginning every day that the slides are up there for you. Tomorrow we're going to talk about how startups make money. We'll run through pricing and metrics. So your pricing and your metrics that matter. We'll start to build out your go-to-market plan. So for those of you who already have one built out, awesome. This will be a super fast process for you. For those of you who are new to this and are technical but don't do sales and marketing, this will be a primer for you on how to do your go-to-market strategy. And we'll talk about traction and product market fit and how you know you're getting product market fit. It's not a vanity metric. Tomorrow we'll start to do some pitch reviews. We'll do the short versions, but as we get into Tuesday afternoon, we'll get a chance to do pitch reviews with all of you and all of your decks. So all of you will be on the call when we do that. And then the final day on Wednesday, you'll have time to do Q&A on the legal stuff in the morning with Ryan and team. And then after lunch, we'll come back for, we'll do breakout rooms for feedback, and you'll have Fauzi, Ryan, and myself, and probably Randa as well, doing feedback for you with all of your decks. So we've given you some time on Wednesday to get some of that, the actual slides done and finished. For some of you, you have some of that done already. You'll see here at the bottom, as well as there's a set of deliverables. These are for you, not for me. I'm not going to review your work. Unlike anything academic or college, this is your business. If you decide not to do these things, that's up to you. Doesn't really hurt my feelings. But from the team's perspective, realize this is a competition. And from the competition perspective, what we want to do is make sure that the teams get the bulk of the work done that you can get done. So it's a chance for you to copy this slide. Don't fill this one in because this is the template. So make your own copy, fill it in for your own benefit. And these are all things you need to get kind of through the process. All right, so those are the info as it relates to that. Let me switch screens here real quick. All right, you guys see my screen there with the Flat6 logo? So let's see, change that. All right. So we'll get to know each other a bunch over the next few days. And at that point, let's see. So from a agenda perspective, DK Parker is the location. You can find most of these things. Are you guys seeing the, let me get swap slides here, swap displays real quick. They'll probably have too many screens on the is that you end up not having, knowing which one's exactly there. All right, so from the bootcamp perspective today, you can find a link, the links on the bottom of the slides, and they're up on SlideShare. Today, we'll do the introductions, which Ryan just did. You guys will have a chance to talk with him as we go through the process and do Q&A, talking about telling your story, researching competitive analysis, markets, value propositions, particularly around how you want to explain your pitch as it relates to the actual seminar itself and getting into the program at the end of the week. And then customer development data. So for some of you who are still early and don't have a lot of traction or don't have any traction yet, the question will be, how do we tell your story if you don't have traction in the form of revenues or users? So that's our agenda today. So presentations and resources, you can find, I'll walk you through my profile as well, but I'll give you a link to the Venture Ready scorecard because I'm gonna have you fill out and score yourselves today, so you have a chance to recognize where your strengths are and where you need to shore up some of those answers as you go into the program itself. All right, So a little bit about me, 5-time founder, sold 3 of those companies, closed 2, raised about $15 million, exited about $85 million. So not no unicorns, all singles and doubles. So if you're familiar with Startup Weekend, I used to run Startup Weekend globally. So we had about 1,265 events that we did worldwide with about 74,000 attendees in 120 countries. So we sold that company to Techstars, and it was a super weird transaction because it was the only time I've ever sold a nonprofit to a for-profit. So a super interesting transaction. I recently had a book come out called Trajectory Startup, and we'll talk about revenue models and those sort of things. One of the unique content about the book is hopefully more than just the unique content, but is how startups make money. And it ended up being a 5-year longitudinal study of 2,600 funded companies, and then tracking that there's basically 14 revenue models that are successful in tech. So we'll break those down tomorrow morning for you as we go through the process. So I've done 13 transactions, so sold 11 companies as of yesterday. We had wires come in for the 11th sell side deal and then 2 buy side deals. So as an advisor and a board member and as a founder. So, but I think of myself as a founder first rather than investor first. I'm an occasional angel, which means in Seattle, where I'm from, and I'm actually dialed in to talk with you guys today from Seattle. So though a couple times a year I'll write a check as an angel investor, that makes me a pretty active angel, sadly, in Seattle. But I would call myself a random angel versus a systematic angel. I'm really more about how do I help founders, and whether it's at the early cycle or the later stage is really about how do we help them land the deal and get the company sold. So biggest company that I've been part of with that was a company called classmates.com. It sold for $156 million in cash. The one we just closed on yesterday was about $52 million. So that fun part of actually seeing checks land in the founders' bank accounts on a wire at the time we close. So that's a little bit about me. So Seattle's home. Look forward to being there with you. Hopefully in September, if that works out, I'll definitely plan on being there because it's a chance to watch your guys' journey as you go through this, and I'll be part of both the boot camp, but also be part of the program, including some sessions with some other founders who've done unicorn companies. You'll get a chance to meet with as we go. So that'll be for the companies who get in. Quick rules of the road. Ask questions as we go. That's totally fine. You don't need to raise your hand, just come off mute and ask a question, because if you have the question, other people have the question too. Most likely is the case. If I'm talking too quick at any point, feel free to slow me down. I won't take offense to it. I'll try to take all the feedback I can. I will warn you, don't ramble. I will interrupt. I know for all of you, you guys have been around the startup community as well, and there's people who go off on their tangents, and we really have a tight program to get you ready for the selection committee. So when I ask you to follow the prompt on the screen and do the short elevator pitch version, it's definitely meant as that. And if you start to ramble too much, I'll just interrupt. So don't be offended by that. Just know that that'll be part of the process. Virtually, I would encourage you to get to know each other. In Seattle, when I first started my first company in 1998, Jeff Bezos and Bill Gates weren't really part of the startup community and weren't really giving back. So, so as you guys have a chance to meet with folks here, you'll find that folks have marketing skills that you don't have, or product skills that you don't have, or technical skills that you don't have. And one of the things we've worked really hard on to make Seattle a great startup ecosystem is to create opportunities for founders to network with other founders. And so that at some point you end up doing this concept of recycled capital, right? So we sell a company, we turn around and go like, oh yeah, I know them. I was in this program with them at Flat6 years ago in Abu Dhabi. I'd reinvest in them again, right? So that's the thing that Silicon Valley has going that no other place in the world has, is that recycled capital concept. So give first along that line. Look for opportunities to support. Look for opportunities to, when we're taking feedback on pitches, feel free to weigh in. As Ryan said, the thing we're missing from the virtual programs is you'll learn as much from the cohort members as you do from the mentors. And I'll walk you through some of my history as we go there too. So you know, having worked for 2 different venture funds, as well as maybe going a third. You never quite know. So, so those are the rules of the road. Questions before we start, or anything I can answer for you before we get going? All right. So this will change as we get further along. You guys will get comfortable with asking questions as we go, and I don't have any concerns about it at all. All right. So first thing I'm going to walk you through is to score yourself. Actually, let me put this into the chat window, and you can download this and score it yourself as well. So on the scoring component here, I'm going to take you through the 10 factors that we looked at that most venture capital companies look at as they invest in companies. Some of them rank them differently and may order them differently, but in general, these are the heuristics that most venture capital companies are going to evaluate you on. This is not the criteria that they're using to select for you for the selection committee. Just know that universally, this is the criteria that most VCs are looking for. They may weight them differently, right? So for example, some VCs think that they rank the team first, some think that they rank the product first. What we did in this process when I was at the last fund was we recognized that we created a fast 4 and a slow 6. And what I meant by that was that there are things that if we like the market and the team, then we would get to how you made money later, or we get to your financial model later. But if we didn't like the fast 4, the financial model really didn't matter much. So what I would encourage you to do here as we walk through this is to score yourself. It's on a 1 to 4 scale, 4 being love it, 3 being like it, 2 being don't like it, and 1 being hate it. Like I'm a solo founder. So if you're a team and you're a solo founder, you haven't made your first sale yet. Your first sale as a co-founder. So you would be a 1. If you have a super well-balanced team and you have a good diversity of skill sets, and you've got technical and you've got marketing as far as go-to-market goes, you may be a 3. You're probably not a 4 yet if there's 2 of you, but if there's 3 or 4 of you or more, you may have a well-balanced team and you're trying to do that. If you're just 2 technical folks and no go-to-market, you could be a 3 because you know your expertise area. But the idea here is score yourself on the team first. I'm going to ask you to do the quick math when we get to the end so you're not surprised. So out of 40, what's your total, by the way? So just jot down a number for team. Second is your idea. Is the idea a big idea? Is it a small idea? Is it a feature for somebody else's product? Is it a brand new product? Is the idea something that can change the world? Or is the idea something that it's interesting, but it could be a tool? So, so big problem, big category versus a tool, or early or late on the continuum. So score yourself on idea. So the next one is product. So do you have the product? Are you pre-product? Are you pre-revenue? So if you have the concept of the product and you're building something out, but you don't have the product in market yet, you might be a 2. If you have an MVP out, it could be a 2 or a 3. If you have a product that has revenue, it could be a 3 or a 4. So go ahead and score yourself on a product. Okay. Next one is market. You'll hear it talked about as the total addressable market or the service obtainable market. We're really just going to talk about market sizing today. But as far as when you look at your product and your company, what market you're going after, is it just GCC? Is it global? Is it just in country? Like how big is the market? And is the market a nascent and new market, or is the market a mature market? So score yourself on your market. So has there been lots of capital raised in this market already? So give yourself a 1 to 4 on the market. Next one is competition. Competition is a little weird one to score on the 1 to 4 basis, but if you have no competition, you're a 1. If you have lots of competition who's raised hundreds of millions of dollars in your category already, you're probably a 1 or a 2. So if you feel like you have a good competitive structure because you know the market particularly well, you might be a 3 or 4. So, okay. Traction's the next topic. Traction is really customer validation, can be in the form of revenue. It might be in the form of usage, could be in the form of customer acquisition. So where are you in the traction scale? If you're pre-revenue, you're going to be a 1. So you don't get credit for traction if you don't have any customers yet or any users yet. But if you've done the customer development and research, you might be a 1. So if you have traction and the start of unit economic data, you could be a 3 or a 4. Timing, this is a why you, why now question, right? So do you have, COVID was really interesting for either extreme tailwinds or extreme headwinds. So is your timing good to market? Is your timing late to market? Is the market growing or is the market shrinking? So score yourself on timing. All right, revenue models and finance. Do you know how you're going to make money? Do you know what revenue model you're going to use? Do you have a financial model already built? So one of the things we won't get done for you while you're here on this program with me, but I will give you access to the 4 most common templates to, is within the revenue model targets. You'll have access to the templates. You can go build yourselves. There's nothing worse than looking at a blank spreadsheet and building one from scratch. So we built 4 templates that are designed for the most popular revenue models, and I'll walk you through that. But that is not one of your deliverables in the time you have during this boot camp. There's just not enough time to do it. It's a big sucking sound that'll just take a huge amount of time if you go down that rabbit hole. So, but if you have one, if you don't know your revenue model yet, no worries, we'll get to it tomorrow morning. You're probably a 1. If you have a revenue model and you have some basic unit economic data, conversion metrics, etc., cost of customer acquisition, you may be a 3 or a 4. IP remote, maybe that you and your co-founder are the 2 best people in the world at this thing, and that's awesome. You might be a 3 or a 4. Most investors don't expect you to have intellectual property or a patent or something perfected at this stage. They just want to know you're thinking about it. Like, how do you build a moat for competitive advantage at some point? So it's not that you need to have it done here, but the idea is are you thinking about it? So give yourself a score on IP. Like every once in a while, I'll see a deal that's like, oh, we're doing it for the community good, and that's awesome, but it's not. It's really you're creating something that anybody else can copy. So, and then the last one is, do you have a clear ask? So one of the things you'll need to make sure you have in your slides for Thursday is at the end of the program is what is it you want to get out of Flat6 in addition to the capital, right? Everybody knows you're going to get access to capital. Now the question is, what else do you need? Do you need access to the GCC market? Do you want to look for opportunities to integrate with one of the partners that they have listed? Do you need a CTO? Do you need a go-to-market strategy? Do you need an independent board member? Like every time you have a chance to pitch your idea to an audience, whether it's on stage at some point again, or virtually, the question is, you're always recruiting, you're always looking for customers, so you're always selling, and you're always looking for something. Just make sure it's a clear ask. So, and then score yourself on that clear ask. All right, here's the toughest part of the day. What's your math? Go ahead and drop your total into the chat window. Just want to see what some of the averages are. All right. I told you you're gonna have to do math in your head. So,
Dave,
yeah.
Dave, can I ask a question?
Yeah, go for it.
I have a question about competition.
Mm-hmm.
In our situation, we have some competitors, but the biggest competitor are some internal tools. So we make tools for game developers, but in most cases, at least now, they're using spreadsheets to solve this problem. Of course, they pay with time, which engineers spend. They have many mistakes, which we solve. But it's not like what you mentioned. We don't have a lot of companies who raise money for this. So
great.
How can we?
I'd probably put you at about a 3. One of the things that I always look at in your example there, Pavel, is that if your customer has created a hack to make something that there's so much friction that they have to create a hack to do it, Like, I love those types of ideas because the customer is already indicating with the fact that they've built a complex spreadsheet to track something, or they've built a script to track something. So I probably rank that as something in the category of a 3. If it's a 4 would be something where it's like, oh, and it's, you know, we're the only ones that do this, and it's $1 billion market. I would be like, that would be awesome, but it's, you know, there's not a lot of $1 billion markets out there that no one's ever gone after. So
Thank you.
yeah, of course. All right, so we've got some mid to high 20s and a 35, right? 34, awesome. All right, so a couple notes here that I want you to pay attention to as you continue through the next few days with me is look at the opportunities where you're a 1 or a 2, and just know that you're going to have solid answers for how you're going to shore those areas up. So if you're a 3, what would it take to get you to a 4? Right. So what I want you to focus on is not just the areas where they're your strengths and ignore your weaknesses. I want you to be able to have a pretty balanced view of this, and like, team-wise, we really need to go recruit a CTO, or we really need to think about what our go-to-market strategy is. Market-wise, we have this new market. How do we talk about it? Is going to be one of the things we'll talk about today. So you'll also recognize that these 10 things are also the 10 slides. So what we'll be breaking down for you as we dig into these is, how do you explain and tell your story in such a way that the selection committee on Thursday walks away going, I know what you do. So keep in mind, for most of you, you have forgotten more about your market than I know about your market. So you really have to take the time to explain to me in a non-condescending way why I should care about your market, right? So we're really going to take that time to really break down your the pieces and what goes on the slides, but also what goes behind the slides. Because what I'm really trying to help you do is, like, how do you go get the market research data if it doesn't exist, right? So, or what's your go-to-market strategy if you don't have a sales and marketing person on your team? So those will be things that we do with you over the next few days. At least you'll be able to tell that story. But know, if the team double clicks on any particular one of these categories, I want you to be prepared to answer based on the research and the work that you've actually done. So not like, oh, that's a great question, we haven't answered yet. That's not the way to make the cut to get into the program, right? So it's okay to not know the answer, but I at least want to point you to it over the next few days so you can go start to get the answer and start to tell a story about why you have a thesis about a particular thing. Okay, so mark this score down. You'll see this on one of the deliverables. We're going to do it before and after, because I want you to highlight, like, okay, I'm thinking about this particular area differently than I thought about it before I entered the boot camp. Okay. So let's talk about why these things are important, what matters about it. Most VCs and investors you talk to really care about what we would call the fast no topics. So, do I like your market? Do I like your team? Do I like the product? And do I like your traction? If I like those things, I want to dig in deeper and learn more about the rest of your company. But honestly, if I don't like the first 4 things, the other stuff doesn't matter much, right? And what you'll see from talking with investors is they have a heuristic or a rule of thumb that they're evaluating every company on. Some do it very systematically and will give you feedback. Some of them do it very randomly, right? So you'll find there's on the old school VC is like, well, we're pattern matchers, which really means we look at companies that look like the companies we've already made money with, where if they're really being systematic about it, they're really evaluating most of these 10 criteria and saying, do we like the company or not? So a quick note on that. So I think for me, as I finished the book, so I've worked, because of Startup Weekend and because of being an investor, I've worked with a few thousand startups versus a few hundred startups. And one of the things I'll tell you that is consistent about that is that we actually like the market better. Now, the market matters more than the team. And the reason is because a great team in a marginal market could produce an result. But a marginal team or an average team in a great market can get a blockbuster return. So market really matters. So some of you will be talking about like, okay, when we do the market research data today and you start to pitch that data tomorrow, I'll start to question a little bit like, well, what's the next market or what's the next adjacent market you're going to go into? That how do you get this to be a bigger idea? How do you get this to be a bigger market? Right. So because what the investors care about is this an opportunity to be really a blockbuster return? Team-wise, for sure, if there's just two of you and you're both technical, or there's just two of you and you're just business, then the question will be like, well, who's going to sell it or who's going to build it? Right. Because there's always that question that says, I have to have more people on my team. And you're always under constraints as a startup, right? You don't have enough cash, you don't have enough time, you don't have enough talent, and constraints are not necessarily a bad thing. Constraints are actually a good thing, but it causes you to prioritize things differently, right? And that's one of the big things that we'll talk about with your clear ask at the end is, what are you going to use the money for? So the concept there is what's called the use of proceeds slide, and it is your clear ask. So here's my milestones. Here's where we're going to get to in the 4 months of the program. What are the deliverables and how am I going to show success? So so that's the team components and the ask components. Product-wise, if you already have a product in market, awesome, that's great. If you don't have a product shipped yet, but you're coming out of MVP or minimum viable product, just know that it's really a product planning. So we'll do a session on what's your product and company roadmap, and how do you tie that to your budget and your financial planning of your spreadsheet ultimately that says, hey, the product's going to ship in September, or the product's going to ship in January, right? So all those things kind of come together in your financial model as well as your go-to-market slide and your timeline slide. Traction is typically something that investors talk about that you don't have, but they want you to have before they write a check. And they typically give it to you in fluffy language. Like, well, there's soft things that we're looking for. That's not true. It's math. So I'll break down the math for you tomorrow on what traction is. And you can tell them what the traction is. But I bring that up because having sat in your chair as a founder 5 times, I'd go meet with an investor and I'm like, that was a good meeting. And they're like, when we have traction, come back and tell me. And I'm like, well, what does that look like? And like, well, we'll know it when we see it. I'm like, that's total BS. Like the fact is it's math, right? So I'll walk you through what your conversion metrics are, how you're going to track it, and I can help you get through that process of what traction is. And sometimes they don't know, and it's just super painful, right? Because you're like, you walk out of, and if you're a first-time founder, and most of you are, you'll walk out of the meeting going, that was a good meeting. If I was in the meeting with you, I'd be like, oh my God, that's a crappy meeting. That was a worthless meeting, right? And the reason is that they're telling you nice things and kind of patting you on the head. So if they're wrong and you get traction, they don't want to miss on the investment. But rather than give you actual useful feedback, which would be super helpful if they were a good VC, they're not going to give you any feedback at all. So you'll walk away and go, that was a great meeting. So I'll give you a quick example. My first startup, I pitched 167 VCs. That's just the math. So now the good news is it's easier today than it was then, but you're still going to have to pitch a ton of VCs to go raise the money. And Ryan and team I've had a chance to work with for the last 2.5 years. They're great in the region and incredibly well connected, and they'll make introductions to you to investors. But you have to qualify the investors as well, right? You have to ask them if this is the type of investment they like, is this the stage they like, is it a vertical market they understand? I launched one of my startups in China, and I found that I could meet with investors because they were super interested in my idea, but if they didn't know the China market, they would never invest, right? If they knew that, so either they invested because it was me and they'd made money with me before, or they understood the problem we were solving and they would invest on that. But like Pavel, your example in the gaming industry, if the investor is an enterprise investor and they don't know B2C or they don't know gaming, they're not going to ramp up and learn gaming, right? So they may say nice things, but it may not actually be useful. So the slow yes components are idea, competition, like those are things that most of the investors are going to dig into if they decide that they actually like the first 4. Just know that that's kind of the way to do it. So when I think about your selection committee pitch on Thursday, I really want you to nail the, do we have the right market? And if it's not big enough, do we have a great adjacent market that we're going to expand into? If we have gaps on the team, this is our hiring plan and part of our use of proceeds. If we haven't shipped a product yet, when are we going to ship the product and what's our validation? So, and then there's other things that are impacting, like timing is really important, especially if you have massive headwinds or massive tailwinds. But if the timing is good, we should be able to tell that story. It shouldn't be something we just look at in the reverse. And then like business model and how you make money, we'll break those down and knock them out in the next couple of days. Okay. So those are the venture ready score. And like I said, we're going to score it now. We'll probably score it at the end of the sessions as well. Well, we will score it at the end of the sessions. But I want you to know where your areas of weakness are so we can answer those questions. All right. What can you change before the final pitch? Some of it is just a matter of going out and getting some more research. Some of it's a question of like what do we need from the team perspective, and how much is it going to cost us to hire that talent? And that may be in your guys' case at the stage you're at, how much equity as well as how much cash. And how can Ryan and team help you find those folks? So I've watched the Flat6 team find CTOs and find go-to-market experts, and all those things are things that they're used to doing. So that's part of the thing that we're going to do for addressing the weaknesses. So, all right, so that's your scorecard as we go into this, and we'll keep it front and center, just knowing that things we need to work on. All right, so I want to do a business model breakdown for you, because a lot of times as we do the early stage startups, the people are like, oh, that's in my business model. And I want to just break down the components of the business model for you so you can look at them and go like, oh, these are the things that Dave's talking about in each of these categories, and they're the things that the investors care about. So the first thing, think of it, this is going to be a Venn diagram. So I'm going to have my 3 circles. The very first in the top of the circle is how do I create value? So value creation is based on my product, my team, and my market. So the first circle of the Venn at the very top of the Venn is where do you create value? It's your product or service. It can be a combination of both. And to your customers, the question is, does it make them money? Does it save them money? Does it save them time? Because I only know Pavel's example so far because he was the one that led with it. In his case, it's really creating value for people who are currently using spreadsheets today. So their competition is, we've created our own tools and hacks to track the stuff we need to track in order to get our jobs done. So the value we create with that as a product is something that it saves them time, increases their efficiency. So that's your value creation, right? So know that that's, and again, it can be a product or a service or a combination of both. So the next piece is how do you deliver value? And delivering value is about your pricing, your revenue models, and your sales and marketing. And we'll break these down over the next 2 days. So how should you price your product? What's the revenue model you're going to use to do the economics? Is it a subscription? Is it a metered service? Is it a transaction fee? Is it a marketplace? Right. So we're going to break down what the 14 revenue models are. You're going to pick them tomorrow. Piece of cake. So, and the good news is with the 14 revenue models, there's been very little changes in the last 7 years. So with minor exceptions. So it's not a question of, hopefully what you're creating as a business is unique. How you make money as a startup is almost never unique. You're going to basically point to a revenue model and go, that's what we're doing. And you're going to pick a primary and a secondary. So it's not rocket science, thankfully. How you price it, however, is one of the big variables. How you sell it creates your sales and marketing expense. So think of it this way, as I have a cost of building my product or a cost of delivering my service. I have a cost of selling that product or service. And what I have left over is how do I capture value? And that captured value is my top line revenue, my gross margin, and my net profit. So I don't control those things. I control my cost to build and my cost to sell. This is just an outcome. So when you think about it from that perspective, what you're really trying to do is like, I need to manage my cost to build it, and I need to manage my cost of selling it. And we'll break down your marketing funnel and sales and conversion metrics and all of that tomorrow. So if it's new to you, you'll have a chance to look at like, how do I do my sales and marketing expense, and how do I figure that expense out? So ultimately, it kind of looks this way, right? If you have, you know your cost to create the product, how many engineers, how many man months, right? What's the product roadmap? How many people do I need to hire? I now have the cost to build it. Now I need to figure out my thesis and what my cost to sell it is. How am I gonna monetize it? Am I gonna do advertising? Am I gonna do direct selling? So this will come into your slide that'll be your go-to-market plan. And then what's my reasonable to exceptional margin? So, because investors are going to look at it from that perspective and say, oh, this is like other companies where we've made money before. So just know, again, that one's an outcome of the first two inputs. It's not something you're going to have a great control over by itself. It really comes down to how am I going to manage my cost of sale and how am I going to manage my, my revenue models. If you do it wrong, what you're going to end up with is something like this, right? Where my cost of selling is disproportionate to what I want my my revenue model to be. So what we're after with this is that can you explain both your cost to build it as well as your cost to sell it? Again, the big thing is come Thursday, you're in a competition with to get into the top 10. If you have unit economic data, and what I mean by that is cost of customer acquisition, lifetime value, what we're going to charge for the product. If you have that data already, you're in a great position. If you don't have that data together, I at least need you to have a thesis on it by Thursday. This is how we're going to go do marketing, right? So, and the reason is because you're going to get a check from Flat6, and it's not so that you can get there and then figure out your testing criteria. You actually want to get your testing criteria up front. So when you get the cash, you can start actually doing the work of testing and getting some actual data. So this difference between who gets into the program and who doesn't. So, and on that note, we'll talk briefly on Tuesday about pivoting, because some of you are early stages, right? And you may come to the stage where you're like, I don't know, I should keep going after this idea or not. So we'll talk briefly about that on Tuesday. But like I said, many of you have existing businesses with existing revenues, and this is really about how do I optimize, help you understand how to optimize your sales and marketing engine so that you can scale it. So if you're currently spending $1,000 a month, what would happen if we spent $10,000 a month? Would it scale proportionately or would it scale disproportionately? And where are you gonna put that money into that sales motion? Okay. So that's the business model breakdown. We'll dig into each of these areas over the next couple, 3 days. And coming out of it and going into your pitches towards the end of the week, you should have some data there where at least you can say, this is our hypothesis on how we're going to do it, even if you don't have data yet to do it. That's fine. But you at least have to have a hypothesis. All right. So startups are broken into 2 epochs. Epochs are basically a point in time. So I think BC, AD, pre-internet kids, post-internet kids, like my kids don't know a world without the internet. Pre-Game of Thrones and after Game of Thrones. So it's 2 epochs. And then pre-product market fit and post-product market fit. So the question is where are you in that scale? And the reason why it matters is you basically have your first sprint as a startup is to get to product market fit. And again, traction and product market fit, it's math. So we're going to walk you through what the math is to get to product market fit. Here's what changes for the investor is if you're pre-product market fit, I'm totally in the risk capital mode. It's a 0 or 1. It will work or it won't. If I'm in post-product market fit or I'm in early product market fit using the math, then the question is my risk starts to go down as an investor. So I'm willing to invest more money to see you grow faster. So pre-product market fit, I have a question of risk and failure. After product market fit, I have a question of growth capital. So if you're spending $1,000 a month on marketing, if I spend $10,000, will you grow faster? So just know that that's the way investors are looking at it. Really comes down to, have you got to product market fit, or can we see how you get to product market fit from here? So we'll break down PMF tomorrow, but just know that that's kind of what the investors are looking at. So risk capital investors, so the average VC would tell you that their top decile investments return the entire fund, right? Where 70 to 90% of startups fail. So what I'm looking for as an early stage investor is what's the signal, and how do I find signal amongst the noise? And should I invest in your company or this company, or if I'm in the case of Flat6, with 30 companies on in the boot camp, which 10 am I going to pick for this? And in most cases, it's going to be based on, is there early indication of product market fit, right? Do the customers love this? So on that note, one of the things I love about what I get to do is everywhere I go in the world, I can show up at a group of with 100 founders in the room, and everybody knows 70 to 90% fail, and everyone knows the math doesn't apply to them, right? We all know that we're going to make it work. We're like, I feel sorry for the other people in the room, but we all know that the math doesn't apply to us, right? So it's the thing I love about working with founders. We're all just on the brink of delusional, right? So, so I want to walk you through the common things of why startups fail. So number one is there was no market need. So this is the CB Insights data. They do it quarterly. They've been doing it for about 6 years. It's super interesting. Somebody said, I know the math applies to us. Yeah, I've always been figured like I was willing to work harder than anybody else, but if you work on this, if you work on a dumbass idea, it still doesn't matter. So, so number one reason startups fail is no market need. So we built a product that nobody cared about. So that's going to be one of the things that the teams look for as we go into this is the thing you're building truly unique or not, and does the customer care? So that's number one. Number two is they ran out of cash. Seems like a bit of a duh, right? But that may be product planning, right? It may be we didn't build enough runway to do an enterprise sales process, right? So, and your job as CEO is to sell the company, to sell to investors, and to go raise the capital to make it work. Not the right team was number two or number three. They got outcompeted was number four. Prices, cost issues is number five. There's a bunch of these you can know before you go do it, right? Is kind of the big picture point here. So if you have a level of conviction, then know that one of the things you're after here is I want it informed by data and facts, right? I'm glad you have conviction. That's required. I'm glad you're passionate. That's required, but it's not sufficient. Like you need actual customer data. So we'll talk about customer development interviews this afternoon. And the thing that you're going to walk away with from that is, what do I need? If I don't have traction and revenue, what do I need from customer affirmative feedback that says that what they're doing is the right thing? Now, I run into founders all the time that will say, well, Henry Ford said if he asked his customers what he wanted, it would have been a faster horse. That's true, and it's pre-internet. And my grandfather owned the first Ford garage in 1911 in Camas, Washington, and all of them were black for a reason. That was the only way they could do it, right? So the point is that your customers are much more well-informed now than Henry Ford's customers were ever informed. So please don't give me a platitude, give me data. So as long as your opinion is informed by data, I love it. I have opinions too. Congratulations, we both have opinions. So what we're going to work on is actually the data that goes with the opinion. Okay, so those are the reasons startups fails. There's 1,000 things you could do to tank this idea. I can't help you with all of those. I can give you some situational awareness that will give you a little bit of repeat founders' view of the world. So, all right. So, yeah, no, the data always wins. We'll talk about that later. So, reading the chat line as we go. All right. So, why startups fail? I also want you to think about context here. Is there's a difference between this where you are at launch and where you are at scale. So, one of the things that us as founders do is we blend those two things together. Right? We think about the business of like, oh, when we're at scale, we have revenue, you have customers, you have capital, you have investment, you have team. That's true. But how I get you from launch to scale is the number one thing I'm concerned about. So given the constraints you have today, right, the question is how do you get to scale? So you'll hear me as we go through pitch reviews and give people feedback is, okay, that's interesting, but that's you're thinking through it as scale. Us as founders, we tend to think through things as if they're at scale today, and they're not at scale yet. So just know that that's the difference here is I need to get you through the launch stage so you can be at scale versus the scale stage. Okay, so getting to survival is important. So judging a startup, if you haven't had a chance to look at Bill Gross's video yet on timing, I would encourage you to look at that. If you click on the big image on the screen, it'll take you to it. It's on YouTube. It's his TED Talk on startups and timing, and I think it's probably the best 8 minutes on timing and startups on the web, but in general in startups. So the idea here is that he went back and looked at both their own portfolio. Gross started Idea Lab, and he was the first incubator accelerator. So he looked at his own portfolio as well as other portfolio companies. So the question then was, okay, well, which made them successful? So, and his assessment at the end of the day was the 5 factors. Timing was the #1 thing. So one of the slides you're going to talk about as part of that slide is, why is this a good time? Why us and why now, right? And I will tell you that timing is difficult looking forward. It's very clear looking backwards, right? So hindsight is completely clear, right? But when you're looking forward in a new market, timing is sometimes hard to tell. However, there are some great things you can look at from a timing perspective. Coming out of COVID, right? Do you have a story to tell relative to that market timing where it's like, now's going to be a good time for this product to take off, right? So one of the things I'd encourage you to tell in your story arc that we'll talk about in your slides is why now is a good time for the product that we're launching. Gross then came back and said team and execution was #2. The idea or the truth outlier, right, that made it a big idea was number 3. Business model was #4, and ultimately funding was #5. So a couple examples of good timing. Uber coming out of the Great Recession was good timing because people needed a side hustle. Airbnb coming out of the Great Recession was good timing because people would have thought renting a room was kind of creepy before, but coming out of the Great Recession, people needed the cash. So the question for you is, coming out of COVID, why is this a good time for what you're doing? So just know that that's part of what we're thinking about as it relates to timing. All right, so I'm going to use a surfing analogy here for you because you'll find that this one gets used fairly frequently in Silicon Valley. I worked down in the Valley for about 3 years for a $250 million fund there. So the wave is the market trend, right? So is it a big wave? Is it a small wave? The board is your product, and the surfer is you as the leader in the team. So the challenge here is that if you're the 5th company to do what you're doing and the market has already raised $250 million, the answer is the wave's probably late, right? You're probably late to the wave. If you're a visionary entrepreneur and you have that on your LinkedIn profile, please change it, by the way. You don't get to call yourself a visionary entrepreneur before you sold something for $100 million. So if the vision is way out there and the wave hasn't hit yet, then that's a problem, right? Because you have to spend money to educate the market before your product becomes successful. So if your product is super sticky and your customers love it, awesome, that's super fun. So I just got back from Hawaii. We actually took a vacation. It was great to get away. But I will tell you, there's a big difference between these 2 waves. One of them is bring money, and one of them is like, that's cute, right? So the story I want you to be able to tell is, why is your idea a big idea? And why is the market timing right? Versus being, meh, like, that's awesome. I'm glad you get to ride that. It's just not very exciting. Okay, categorizing your solution. A few more things, and we're going to go to a coffee break here at the top of the hour. So one of the things I want you to be able to categorize your solution with is, are you B2B? Are you B2C? Are you a product, or are you a service? You may be business to government. That's going to be pretty niche-y for Flat6. It doesn't exclude you necessarily. You may be a marketplace, which means you're B2B to C, but that's usually an indication of a marketplace. And usually as a startup, you have enough cash to go after one market, but not both B2B and B2C, right? So when you're cash constrained at the early stage, you have to pick which market you want to go after first. So in a B2B example, if you're a product, Salesforce is a great example of a B2B product. If it's a B2C product, it could be a gaming company, or it could be Spotify as an example. If you're a services business, like a consulting company, or you're doing a part of services like non-recurring engineering where you're building a product for a customer, that's great. Services businesses are great businesses. They just aren't venture scale. And if you're B2C selling to consumers as a service, it's just a tough business. So know that there's markets that venture capitalists like, and there's markets that venture capitalists don't like. Let me put some numbers to it for you. We'll talk tomorrow in detail about what the revenue models are. If we were to run a B2B services company doing consulting and we did $1 million in revenue, and we went to go sell that company, which is where I spend most of my time today, that company would sell for roughly $1 million. So it sells for 1 times revenue. If you're a B2B subscription company, that company's valuation is going to be somewhere between 8 and 12 times revenue. So that same company it took us just as long to build $1 million business, but if it's $1 million subscription business, that business is going to be worth $10 million instead of $1 million. If you're a metered service business like Twilio or AWS or Azure or UiPath, that business is going to be worth somewhere in the neighborhood of 18 to 24 times revenue. So the reason I bring it up is when you can choose your revenue model, it can have a dramatic impact on the valuation of the company, which determines your pre-money value, right? So if you're a marketplace, you have a different multiple. So if you're in the transaction fee business versus recurring revenue subscription business, you have a different multiple. Each of the 14 revenue models has different multiples. So where you can control it and actually set it up, great. If you've chosen a business you can't control it, that's fine too. Just know that it's going to dramatically impact your valuation and your pre-money value. Now, everybody wants to be a unicorn, right? The question is, only some businesses get to be a unicorn. The ones that do are disproportionately new and nascent markets, which means it's not a $1 billion market yet because no one's got there yet. And they typically have high subscription or high recurring revenue rates, right? So it may not be a subscription business, it could be a marketplace like Airbnb, but the frequency is super high. So there's some variables that I can give you that will have dramatic impacts on how you value the company. So, and by the way, this is where, again, back to data wins. We went back and looked at about 400 publicly traded comparables, because ultimately that's who you will probably sell to. And they're going to give you a value multiple on your revenue that goes to their market cap. So without getting too geeky about it, we'll talk more about it tomorrow. But just know that investors are going to look at it and go like, is this a venture scale business? Is it a services business? Is it B2B? Is it B2C? So if you know what you are today, just make a quick note. And wherever you're taking notes, we're a B2B product company, or we're a B2C product company. If you're, and this is a question of who pays, by the way, right? So in the case of Facebook, Facebook is in the advertising business, right? You and I who use Facebook, we're the product, right? So though consumers are their users, the people who pay are businesses. So, and get crisp on that, because one of the things that happens with us as startups is we tend to blend our who pays and who uses us into customers, and it can be confusing for the selection committee if they don't understand. Okay, so categorize your solution. All right, what's the problem or the opportunity? Is it a pain pill or is it a vitamin? One of the things I want to help you get to for selection committee is convincing the selection committee that this, even though they may not know your market, that if they understood the market the way you understood it, they would understand that your product and solution is really solving a pain problem, not a, it'd be nice to have problem, right? So really convincing of that, that's important. You want to be able to explain the opportunity and the future growth of the market and why your solution will really matter. So if you fall short on that one, you just won't get in the program. And then who are you solving for? Are you solving for making money or are you solving for saving money? So if you're selling to business, right, the VP of sales always has money to make more money, but the VP of HR may or may not have budget to save money. So who your ideal customer profile is, your ICP, right? So we're going to talk about who your launch ICP is going to be in your go-to-market strategy. Again, not at scale, you may have a very different customer profile, but at launch, I want you to be super focused on who your ICP is, because again, with limited cash and constraints, limited number of salespeople, usually you to start, I want to make sure your ICP is super clear, and you should be able to communicate that to the selection committee. And can you capture value? Will people pay you for it, right? Is it something that's nice to have or something they have to have? So knowing that you can capture value for that is super important. From a company roadmap perspective, one of the things that we're going to work on positioning with you as we get into day 3 is, are you more than a product company? Do you actually have a plan for being a company, right? So in addition to the first product, what's the product roadmap? How much cash do you need to do that? I will warn you in advance that I don't like platforms. Usually platforms at the early stage is we don't have any customers yet and we don't know what it is, but we're going to call it a platform because it sounds better. I want you to be a product first, right? So your customer can understand it. A platform is something you can build on, deploy on, and manage on. So please don't be a platform, because what VCs hear and what investors hear is, oh, well, you don't have any customers yet. So be a product first, right? And if somebody comes in and pitches their platform later, I will encourage you to be a product first, platform later. So grow into a platform. Lifestyle businesses aren't fundable, right? So you may have a services business, great. They usually don't make it into this program. There's also local businesses versus scalable businesses. What VCs want to know is, when I look at my portfolio as an investor, can your company return the fund? You know, Ryan talked about the company that used to be called Harmonica. It was a 16x return on investment. So most funds return around 3x on the lifetime value return of the fund. So as I look at my portfolio, if I have 25 companies in the portfolio, I'm going to look at your company and say, can your company return the entire fund? If I'm later stage of investing in that fund, I may be like, this one's interesting, but it's probably going to get me a 3x on my money. It's not going to get me a 16x on my money. So know that that's the way the VCs are looking at portfolio management. And we'll talk about investor profiles in day 3 on Tuesday. Like, who are you calling on? What's the investor profile? What do they invest in? And we'll go through investor profiles on that day. And then services versus products, and I already talked about exit multiples. So know that that's part of what we're going to be looking at, is what's your blend of revenue? All right, last few things before we go to break. Should you build it? So this is an example of, so some things you can build, but you shouldn't build. So this is Belty. It was in TechCrunch a few years ago. It was an app that you could use to adjust your belt after you had dinner. Now they pivoted though, and they became a battery storage device, so you could plug in and charge your phone. Again, it's something that it could be built, but it shouldn't have been built. Or some of you probably remember this one. Anybody remember Juicero? This could have been an example from Silicon Valley had it not happened in real life. So they raised $120 million and burnt it. And basically, it was a juicing machine that they would send subscription packets for, but you could squeeze the packet with your hand. So they burnt through $120 million and crashed in a massive crater. So the reason I bring these up is there's things you can do, but you shouldn't do. So one of the things I'd encourage you to think about is that, and it doesn't mean you can't raise money for it, by the way. In this case, they burnt through a bunch of it. So know that there's things you can do, but you probably shouldn't do. So with that, we're going to take a quick 15-minute break and grab a coffee, refill, and whatever you need to refill. And we'll be back here in just a few minutes to dig into your slides and what we're going to be doing for your slides and your format. Questions before we go to break? If you're asking something, I can't hear you because you're on mute. Feel free. All right, so I'll hit pause on